to EDC Milan in Italy, where we report on the Italian pension reform happening due to the COVID-19 pandemic. We go live to our report now. We have April Paulino. April?
Hi, Giancarlo. Thank you. European policymakers are generating new market opportunities for Italian pension funds through credit card lines of the European Stability Mechanism, European Investment Bank loans, and the EU's Recovery Fund. Prometei Advisors team recently signed a memorandum of understanding with the European Investment Fund to reinforce the cooperation for equity investments through pan-European institutional funds of funds. As Italy emerged from the lockdown, with the reopening of most economic activities, the central bank, Bank d'Italia, forecast that the COVID-19 crisis will cause a 9.2% contraction in GDP this year. It foresees a gradual recovery over the next 2 years, with growth of 4.8% in 2021 and 2.5% in 2022. The mission of pension funds to generate returns for members at this age is compatible with a significant amount of investments in Italy, a market that is still small but is growing. Chairman of Itinerari Previdenziali, Alberto Brambilla, said, pension funds are a guarantee for workers in old age, also thanks to complementary insurance policies, while PIRs do guarantee either the economy or the individual saver, but tend to invest in the liquid segment of the stock exchange. This government should deal with the situation by starting to reduce tax on pension fund returns from 20% to the original 10 to 11%, and avoid levying tax on the funds annually as if they were speculative products. The TFR represents the larger share of the inflows to open pension funds, pre-existing funds, and fondi negoziali. For businesses, TFR is an alternative bank financing, allowing SMEs to spend resources that belong to the worker, but are available to the company until the worker leaves the job. TFR should not be taken away from companies and put into pension funds that invest 3 to 4% of their assets in Italy and the rest abroad, he says. The government tried to encourage investment into the real economy by creating Piani Individuali del Risparmio, or PIR, individual saving plans that enjoy tax relief when investing in Italian businesses. Back to you, Giancarlo.
Thank you. And how about the pension fund for this year? Should they expect it to arrive, and who are those who will benefit?
Money from the 14th month will arrive this July, a sort of double pension. It will be received by those with at least 64 years of age with a maximum income of up to 1.5 times the minimum treatment, which translated means not to exceed the income threshold of 786 euros. The additional allowance, according to Legislative Decree 81-2007, are senior citizens, early retirement, disability pensions, and survivors' pensions. The pensions, however, without 14th are those of civil invalidity, social allowance, war, and INAIL annuity. INS has already communicated that 3,150,000 will receive 14-month pay. In addition, there is no need to submit any application. Payment will be made automatically by INPS. Those who will turn 64 this year will receive the 14-month pay in the month of December.
Thank you for your report, and thank you for joining us today, April.
Thank you, Giancarlo. I am April Paulino, reporting live from Milan, Italy, and we live in interesting times.